Today we're going to be spotlighting the SPDR S&P 500 ETF, which currently has a market cap of over $250 billion. This is a very high number and one that I would be more concerned about if this was an actively managed fund. But since it isn't actively managed, that isn't as much of a big deal. With those actively managed funds, once you get over about $100 billion, you can start to worry that the fund managers are going to have a tougher time finding good value to chase with all of that cash. But with this not being actively managed, that's not as much of a concern. Still a very large ETF here. It's a large blend, and its fund strategy is basically just to mirror the S&P 500. So we go down here, its inception date was in 1993. So we have a lot of historical data that we can look at when looking at the return of this ETF. Its net expense ratio, 0.09%. Of course, this is a lot lower than what you're going to get with actively managed funds, but in terms of these ETFs that are not actively managed, it's a little bit higher. You can certainly find cheaper than 0.09%. So that's one negative here with this particular ETF. Moving on down here, you can see portfolio turnover only 3%. Again, you would expect that here. All of the positions are long for this particular ETF. It has 506 holdings, and again, you would expect that. There's no minimum in terms of investing in this. You can just purchase however many shares of this you want. You're going to have to pay a transaction fee for whichever brokerage company that you're going through to get this particular ETF. But let's move on here to its performance. So as you can see, this SPY here has very similarly gone with the S&P 500, almost the exact same over the course of the past 10 years. If you just compare it over to the average large blend, which is what this SPY fund looks to do, it's actually outperformed that pretty consistently here over the past 10 years. So that's pretty impressive there, a nice positive mark. Let's go over to distribution. You can see it's a pretty constant distribution here of dividends on a quarterly basis. This has an annual return of dividends of about 1.77%. And now let's move over to the holdings. So it's top 10 holdings here. You would expect to see a lot of these in just your typical American market securities. They've got Apple, Microsoft, Amazon, Facebook, JP Morgan Chase, Berkshire Hathaway, Johnson & Johnson, Alphabet, and ExxonMobil. And their top 10 holdings are a little over 20% of their entire assets. Moving on, you can see that it's almost entirely in U.S. equities. And then we go down a little bit further here, and you can see technology is the main percentage of their holdings, followed by financial services, healthcare, consumer cyclical, and so on and so forth. So let's just for fun compare this SPDR S&P 500 ETF performance through its lifetime against the Dow Jones Industrial Average. So as you can see, the Dow Jones has actually rather significantly outperformed the S&P 500 ETF here from SPDR over the course of its existence. This is spanning about 25 years. It's gotten about 50% more return over this particular period of time. So very impressive there from the Dow Jones Industrial Average, outperforming the S&P 500. So that's basically going to wrap up this video, guys. A lot of people have their money in the SPDR S&P 500 ETFs. It's one of the biggest on the market here, and if you're just looking for a consistent return from a large blend here of all different sizes of companies within the United States, then this is a decent option to go with. That net expense ratio at 0.09. Of course, it's much cheaper than you're going to get with actively managed mutual funds, but still you can find cheaper out there, and I do recommend going after those cheaper net expense ratios because that's only going to benefit you in the long term. So thanks guys for stopping on in for today's video. If you have any recommendations or ETFs or mutual funds that you want me to spotlight in the future, just throw those down in the comment section. Subscribe for more of this content, and we hope to see you in future videos. Bye.